Wonderful. So welcome, everybody. Thank you for joining. It's a great day. It's a somewhat rainy day. So we're going to get started. We're going to introduce some people to everyone that's here. So I'm going to start. I am Brett Furman. I'm the broker owner of Remax, a real estate company. I've been doing this for 36 years, all kinds of things, primarily in the residential real estate space. And my specialty is representation of home sellers. Also on the call, we have my associate, Tracy. Say hello, everyone. Tracy, say hello.
Hi, everyone.
Hi,
So,
Tracy.
Tracy's a great person to have on the call today because she was responsible for connecting two of our guests together, and we'll talk about how that all happened. And so you previously were a resale director for a 55 plus community. You have extensive experience in the seniors real estate world. You have the real estate specialist designation, the seniors real estate specialist designation. So you took some extra training and classwork. So welcome, Tracy.
Thank you.
And our co-host and special guest, Lydia. Say hello to everyone, Lydia.
Good morning.
So
Happy to be
Lydia,
here.
you have a very diverse background. We love having you as a co-host on all our ABCs of senior housing webinars. You have a very interesting background. You've been in a lot of different facets in the senior world. So most presently you're at Beaumont, but you've had some different experiences in the home healthcare arena with Bayada, Senior Helpers of Lansdale, Axe Home Healthcare, Dalesford Crossing. So you've been in lots of different facets of the senior world, which we love having you and welcome.
Thank you.
And our special guest today, Julie, we had a great call last night with you talking about all kinds of things that you do. You have, it's kind of like, I call it a myth, if you will, or like people just don't understand a lot about what reverse mortgages are and the benefits and how they can help the people that are on the call today. But you've been doing this for 15 years as a specialist in the HECM world. And you're going to talk to us extensively about how that could benefit people and how you educate people, which I find really interesting. You're really very educationally based, and you like to explain the benefits to people that need your services. So welcome, Julie.
Thank you. Thanks for having me.
And just a quick, before we get started, those on the call, and welcome. We have a lot more people that have signed on, so welcome. If you want to throw a question up in the chat, you're welcome to do that. Depending on how many people and how many questions, we'll try to take them as they come or save some time at the end. Those on the call, don't forget, you have access. We have a home concierge service. It's available. It's free. We have all kinds of vendors for you besides Julie. If you need a reverse mortgage, we have senior attorneys, we have elder care financial planners, we have electricians, painters, handyman. And this is for those, Lydia, we talk about aging in place and being proactive and reactive. And certainly if there's things you need to do to your house to get it on a proactive basis, so you're ready, we have all kinds of people that can help. So feel free to take advantage of that anytime and give us a call. What today's all about is we're going to try to give you some update and education in something that people ask all the time, which is, are there any kind of financial opportunities available for the senior world? And the answer to that question is yes. And our guest is going to talk to us today about some of the things here, which is, who can qualify for a reverse mortgage? Is there some kind of like age minimum? What are the benefits and who can apply? And without further ado, I'm going to turn it over to Julie, but tell us a little bit, if you could, about the reverse mortgage world and how do you use it? Who's using them? How do they work? And what's the benefit to the people?
Well, for the purposes of today, I'm mostly going to talk about what we call the HECM. HECM stands for Home Equity Conversion Mortgage. It's just the name that's specific to the reverse mortgage that's backed by the government. It's FHA insured. Some of the big lenders have what they call proprietary products that are reverses that are used for just kind of a certain niche when maybe a HECM won't work for somebody because too high of a home value, or it's a condo that can't get approved. I might be able to help them with that other product. But 99% of the reverses that are written are the government-backed loans. So that's what I'm pretty much going to talk about.
And it's interesting because I never knew that there were additional products besides the reverse mortgage. That's very interesting.
That's really only been in the last few years. I think when rates started going up more, that became more and more of a thing. They're less costly because they don't have the FHA insurance that I'll talk about a little bit later, but because the lender is backing it instead of an insurance fund, they do have a little different loan to value. But for some people, it gives them sufficiently what they need, and it's a good option. But I've only, I think, done one of them in all these years. So
Got it.
for the HECM reverse, there's two distinct uses of it. And for 30 plus years, the refinance has been around. And you've probably all seen commercials on TV with Tom Selleck or, different
Yes.
stars that come and go for
Yes.
different companies. Yeah. And it's about the refinance, use your home to stay at home type thing. And when somebody does that, what they're trying to do is convert their asset of home equity, which is an illiquid asset, right? The only way you can get at it is to borrow against it or to sell your house and cash in. The reverse mortgage lets you get your equity out of your house and turn it into a usable asset, turn it into something you can pay bills with or pay for healthcare, that type of thing while you're still living there. So that's what the refinance would be, a house you already owned and tapping into your equity. The other use of it is for purchasing a new home. I think this is the best kept financing secret out there for people looking for whether it's a new construction home or a resale home, but a different home that might be more appropriate to age in place or might be closer to family. You can actually use a reverse mortgage to buy a different house. It can't be for a vacation home. It needs to be for the house you're going to move into, your primary residence. And that's only been around since 2009. So it's the exact same loan that's been around for 30 plus years, but in 2009 had allowed it to be used to buy houses. And that's because they noticed that people in that age group of 62 and older were in fact buying houses, but they were getting a mortgage that they would turn around like a year later and refinance into a reverse so that they no longer had to make payments, or they were paying cash for it. And then in a year or two, getting a reverse to get their cash back out. So someone had the bright idea, why don't we just let them buy a house with the reverse mortgage to begin with? And then they have one transaction, one set of closing costs instead of two. So that's how that came about, but it's still a best kept secret. It's been hard to get the word out about that.
Do you think that's with these TV commercials, and I do see them, they roll all the time. It seems to me that there isn't that educational process with that. They don't really like explain the process. Is that how you differentiate yourself in terms of what you do?
Yeah, I think it's hard in 30 or 60 seconds to really go into this and really explain to people what it is. I can do a 1-minute elevator speech. I can talk for an hour nonstop because there's just that much to know. So that's why I'm so into the education of this. I'm never going to talk to somebody one time and expect them to make a decision. Sometimes people circle me for 2 years and they just call a few times a year when questions pop into their head or to check on rates or something like that until they can, make a decision that they're comfortable with. And I welcome that. I just, whether they end up doing it or not, they might have a friend who ends up doing it. So the more people who know what this is, the better. And I also think the TV commercials go after, in the old days, these loans were thought of as loans of last resort.
Right.
They're for needy people.
Yeah.
So you tend to see an 80-year-old woman on a walker coming up to Tom Selleck or, Pat or whoever it is. And
Yes.
These days, through a lot of education and through academics who've studied these loans, it's really not thought of so much as a needs-based thing anymore. Certainly the purchases, and I just closed a house worth nearly $1 million out in Pittsburgh a month ago. So needy people aren't buying $1 million houses, that's for sure. But it's actually a very smart financial planning tool. So that's the big difference. That's what I want people to understand. It's not something for somebody who's necessarily needy. It's something that can just be very smart financially.
Got it. So would you tell us a little bit about how they work in terms of, the most important thing that I'm like astounded by, and it's that it's a non-recourse loan, and no one really understands the word of like non-recourse. And basically that means that if at the end of the rainbow, if you decide if the house is worth less money than what it was, you can basically like walk away from your loan and your heirs would not have any financial obligation. You're not personally responsible for the debt. Is that pretty much the way that works?
Yeah, absolutely. And it doesn't matter whether it's someone's longevity, because maybe they took this loan out at 62 and they lived till they were 102, or if it's time for them to dispose of the house, and I'm gonna knock on wood, the housing market crashes again. So it's just bad timing. Doesn't matter what the reason is, if they end up owing more on the loan than the house is worth when it's being disposed of, or they're permanently leaving it, they're not responsible for that. So the FHA insurance that's part of these loans would step in and make the lender whole. Yeah, so if somebody owes $400,000 and appraisal's done, the house is only worth $350,000. The house will be sold, the realtor will get paid, the Pennsylvania transfer tax, if you're in PA, would get paid. The rest would be applied to the mortgage loan. It's not enough to pay it off. And if it's a matter of the borrowers being deceased, maybe they left life insurance for their heirs or substantial accounts they didn't spend, but we can't touch that to pay back the loan. That's going to go to the heirs. The FHA insurance is what makes up the difference.
I mean, that's a huge benefit right there. And it's the only loan that I know of that has that, unless you're in a commercial world where you're buying commercial real estate and there's a life insurance company funding it. Sometimes that would be a non-recourse, but in the residential arena, I know no other way that you can have a non-recourse loan. Does that sound right?
Right. And that's the biggest consumer protection with these. And that's what a lot of people don't know, because it sounds great. Yeah. Sounds great that you can have a loan with no set maturity date and no obligation to make a payment. But some people think that that's too good to be true, especially when you tell them that they have no personal liability to repay the loan. And it's very blunt in the closing documents. There's a document that says, I understand I have no personal liability to pay this loan back. And people think it sounds too good to be true, but it's that FHA insurance that is paid for as part of the loan that makes that possible. And it would have been 2008 when we had like house values plummeting.
Yeah, 2008.
Yeah, so,
I remember it well.
Yeah.
2007, 2008, the market was going up, up, up. And then all of a sudden, boom, it just, and they were giving loans to people. It all was, if you were breathing and the house was standing, here was your loan,
Right. And not even just giving them loans, but giving them loans at like 95, 98% loan to value, right? So they owed almost what the house was worth when they bought it. And then 2 years later, that $350,000 house they bought was maybe worth $280,000. It doesn't matter if it's a traditional mortgage, you owe $350,000 if that's what you borrowed. It doesn't matter that the house is worth less. That kind of thing can't happen with our loans. Because like I said, it doesn't matter whether it's a market that's gone down or just someone's longevity or a combination of the two. They're never going to owe more than what the house is worth. So that's also a good protection thing for the heirs, because some people might look into this and think it's a really good idea for them, but they're really concerned over not putting any kind of debt or hardship on their heirs. So they want to know that what they're doing today to help them live more financially stable isn't going to affect their heirs down the road.
Julie, can I ask you, is this the FHA you're saying that came into effect in 2009? Is that
no, FHA's been around since
right, you're right.
89. Yeah.
But
just
for reverse
buying a house. Yeah, that you're allowed to buy a house with it.
Okay. Because I know way back, reverse mortgages, there was always a little bit of like, oh gosh, last resort, you're elderly person. How is that going to impact? So this is really fascinating to know how it's changed and with the consumer protection.
Right. And, Brett and I were talking last evening, and I said, I understand when people are a little leery of even calling to find out about these, because they hear bad things when they're playing bridge or something, but it's usually from people who don't really understand what the loan is. And before I got in the business 15 years ago, my mother approached me at some point and said, what do you know about these reverse mortgages? Because I'm starting to have a hard time paying my condo mortgage. And I said, oh, I think they're bad and I think they're expensive. And I didn't know why I was saying that. It's just because that's what I'd heard, right?
Yeah.
So I did a deep dive. I ended up talking to a loan officer in Philadelphia. I put this guy through his paces, 3 or 4 phone calls, because I was just determined to find out what the got you was, that there had to be a catch to it. And as it turned out, it was a perfect answer for her. It kept her in her house another 6-7 years. And it was just a little condo that she could stay in by herself. And it made a big difference to the quality of her life to be able to do that. So, yeah, I get it. I tell people, don't be afraid. If you've heard a horror story, run it past me, because I'm going to tell you how that could have happened or if it could not have happened, just because these things tend to snowball. But I want people to ask those questions, those hard questions. So as far as what people can get from these loans, these are age-driven loans. So if I'm talking to somebody 62, 72, 82, they're going to get very different amounts of money. So it's kind of like how life insurance is priced for people, right? We know they're non-recourse loans, but this wouldn't be a viable product if every single loan was, people were given enough money that they were all going to end up in insurance claims. So somebody who's 62 is going to get less money than somebody who's 82 because it's just assumed they're going to live in the house a lot longer. So every single person is going to have a different amount of money that they can borrow depending on their age, the value of their home, and the interest rates. To qualify for the mortgage, as I said, they need to be 62. That's the minimum age. I can take an application from somebody when they're 2 months before age 62, as long as we don't close till the day after they're 62. And I do want to mention, if it's a couple, if we have a husband and wife, only one of them really has to be over age 62. And this is something too that's only been, I'm going to say maybe half the years I've been in this business, so maybe 6-7 years ago, came up with protection for what we call a non-borrowing spouse. So if I have a couple, if the gentleman's age 65, the wife is say 50, now let's 59, you really don't want the numbers too far apart. The 59-year-old can be on the house title, but they can't be on the loan because they're too young to qualify. But they are protected under the FHA non-recourse safety. So if the borrower would predecease the non-borrowing spouse, that non-borrowing spouse wouldn't have to pay off that loan and get out of the house right away, right? They'd be able to stay living in the house.
Really?
No obligation of payments if they stay there 10 more years, and they have to be able to meet their obligations, property taxes, HOA dues, homeowners insurance, right? So as long as they're staying physically living in the house and meeting their obligations, they could live there another 10 years or so. And if it went technically underwater, they're not going to owe more than the house is worth. They're covered under that non-recourse feature. So that's with a non-borrowing spouse. The only caveat on that, I believe, if I have a refi and I have people like that, if they're doing this to set up monthly non-taxable income to themselves, I might talk them into waiting till they're both 62, because if the borrower would become deceased and they're setting up monthly payments, they're counting on the monthly payments would not keep coming. Once the borrower is deceased, the non-borrower couldn't get more funds out, but they could stay there and not have to make payments and be covered under the non-recourse. And they might qualify to get their own at that point, but you really don't know.
Julie, is there a limit? You mentioned, I think I heard you say 82. What happens if you go to 83? If, say, I'm 56, my wife is 62, we go and my wife gets the reverse mortgage. Does that mean if she were to pass away can I stay forever in the house? Is there a limit on?
No, as long as you're meeting the obligations of taxes and insurance and living in the house, you can stay there as long as you want to stay there.
Okay.
Now, we do have to adjust the amount of loan proceeds to the age of the non-borrowing spouse, though. So if you've got a 65-year-old and he's married to a 40-year-old, those numbers just aren't going to work because of the life expectancy of the 40-year-old. It's more if there's a few-year difference. Yeah.
Okay.
So it used to be in the old days, if somebody was 62 and they had equity, they got this loan, period. We weren't even allowed to underwrite it. But about 5 years ago, we had the ability to underwrite these loans. And now to qualify, it is really very similar to a traditional mortgage in that somebody needs to have a good credit history because they do pay their own property taxes when they have this loan. We got to look back 24 months, make sure there's no late payments on property taxes, because the only way they could default on our loan is to not pay their property taxes on time. So that's important. Again, a good credit history. We do income qualifying as well. And it's not quite as strict as traditional mortgages, because if you think about it, there's not a mortgage payment for me to hold them accountable to see if they're going to qualify. And we can use different types of income, the things that tend to be retirement income that a traditional lender might not be able to use with their types of loan. So there is underwriting. You need that good credit history and you need to have sufficient income because we want to make sure that it's not a Band-Aid loan. We want to make sure that it's a good long-term fix and the person can afford to pay their property taxes and their homeowner's insurance so they can stay in the home.
But typically the borrower is typically not working, right? They're typically retired, correct? Isn't that so when you talk about income, are we talking about other than
pensions and
like Social Security or other things? Is that what you're
Social
counting?
Security, pensions, annuities.
Pensions.
Could be interest and dividends, if that's pretty standard. One thing that does make it easier too, if I have somebody who has a house that's free and clear, we can actually use the payout of the loan, like how much we're going to be able to get them when the loan closes, and kind of bulk up their income that way. In the northeastern states, if I have a couple applying, they only need $906 a month more in income than they have in obligations. So it's not a terribly high bar. And again,
Okay.
there's no mortgage payment to hold them accountable for. So I don't have as much obligations to compare it to like than a traditional lender would. Because if you're getting a traditional mortgage and maybe it's $2,000 a month of a mortgage payment that I have to use for a debt to income calculation. So most people will qualify, and we try to make it as easy, the path of least resistance. If we can qualify them just using their Social Security, that's what we'll do to try to help them not have to give us every piece of paper in their office. So it's a little bit different that way. We have to have that good credit history, not like in the old days when they just got it if they were 62 and had equity. So if we do have people who they're not willing to get educated and they hear the misconceptions about these and they're afraid to call, it's upsetting to me when they wait until they actually have some problems, like maybe they've run behind on their property taxes and then they finally say, okay, I need to find out about this, because at that point I can't help them. So people need to really check into it when they're still, paying their bills on time and have that good credit history long before they actually really need to do it.
Would something like, I'm just picking an example on the credit report where they didn't pay their cable bill, does that hit your radar, or is it really the property taxes you're looking for more?
Property taxes and anything that shows up on the credit report. So
okay.
Credit cards, car loans, things like that. Medical collections, we don't have to put much weight in, just because that's kind of a whole nother thing. You can't always count on them actually being a bad thing. So, and for home purchases, the big thing is, do they have their required investment to bring into the deal? Because it can't be borrowed money. So it could be net proceeds from a departure home they're selling, retirement funds, investment funds, anything that they currently own for their portion of the one-time investment that they add to the loan funds to complete a purchase. So that's a big qualifying for the purchase deal.
Interesting. Okay. So what about the benefits, and how about to their families? Because that's really, are you dealing primarily, do you get a lot of business from the kids? Does it come that way? Or are you dealing primarily with the seniors? And how do you talk to the families about this?
It's all over the place. Sometimes for, somebody older in the age group, somebody in their 80s, sometimes they have adult children who are helping them out with their finances and helping them, find answers to things. And sometimes I will get a call from, an adult child of a senior who's starting to have trouble. And the big thing that's a pro for the kids, I've run into some kids who just want mom and dad's house free and clear and mom and dad's money, and they think they're entitled to it. Thank goodness I don't run into that very often. Most times when I'm working with people and I talk to their adult children, they're all about what's best for mom and dad. What mom and dad can do for me is let me know that they can afford their medication and their food and to live, where they're not crazy stressed over their financials. So I think knowing that mom and dad are taken care of and that they can use their home equity to fund their retirement years is a big load off the kids' shoulders as well. And then, of course, for the homeowners themselves, just improving their retirement lifestyle. There's so many different things they can do with these loans. For some people, it's a peace of mind loan. They may take this reverse mortgage out and not take any money out right away. They can actually leave the money within the loan in a growing line of credit and just draw it out as needed. So if they suddenly, their car goes kaput, so they need to get a new car, but they don't have enough income to qualify for a car payment, right? They could take $26,000 out of the line of credit from the HECM loan and go buy a car, and they're not going to have a monthly mortgage payment because they use the money out of the reverse mortgage. They can use it for any need that they have. If there's somebody who just wants to do a lot of travel during their retirement years, maybe they want to take a big trip a year and they can use their money for that. But they can keep it in a line of credit. They can set it up where they get draws monthly, where we direct deposit $1,200 a month to their bank account the first business day of the month. Sometimes they'll do this because they might have a nice amount of retirement funds. Maybe they're getting a really good return on it. And it just makes more sense to not pull that money out because it's growing so well, and to use some of their home equity and have that sent to them monthly so they can stop withdrawing from their retirement accounts where they're getting good returns on them. If they're starting to dwindle their retirement money and they're starting to get uncomfortable with what's left there, again, they can kind of leave that intact get one of these loans and start taking the monthly money they need from the loan and keep their other assets intact so that they can still be growing.
So you have kind of two options. You could take it out slowly or take it out in bulk. Is that what
Right.
I'm hearing?
Mhm. The smart thing to do is use the money as you need it. We don't want people to get one of these loans and take a lump sum out when they don't need it, because once they draw the money, it's accruing interest, right? So they're not making payments. The loan balance is rising by the interest. Okay, so every month they get a statement and they can see what they owe. They can see what's still available in their line of credit if they set up a line of credit. And the line of credit actually grows. So if I say to a borrower, okay, if you took a lump sum today, you could get 100,000. But if you use this money slowly over the next 10 years, you're going to get 135,000, because that unused portion grows every month by the same amount their loan balance would grow. Yes. And they're not charged interest on what's there waiting for them to use it. And if they don't use it, it's not in the loan payoff. So it never costs them anything.
So it's only when you draw the money, only when you draw
Exactly.
is when you're.
Yeah. So
And how do the rates vary versus a regular conventional loan? Is it, or an FHA loan? Are they similar in interest rate structure?
yeah, I mean, it's funny. I would expect them to be a lot different, but honestly, they're not. It's really, comparing apples and oranges, because our loans are just completely a whole different animal than a traditional mortgage. Traditional mortgages, the balance can only ever go down because people are making payments, which is a good place to say. With our loans, people could make payments if they choose to. And I do have some people that get these loans out right when they're 62, and they're going to be working for 5 more years, and they might make payments for those 5 years, right? But then they can stop anytime that they want. So people do have that flexibility. If they do want to pay it down or make payments, they can, but they never have to. Our interest rates, just especially recently, I've kept more in touch with that just because of how the rates have gone. They're very similar to the forward mortgages, the traditional loans.
So we talk about on the ABCs of senior housing, Lydia, all the time about, the pros and cons of aging in place. And obviously this program is really designed so that somebody could age in place, right? And use the funds accordingly so they can stay in place if they need help or to position the house properly, add, lifts or things in the house so they can stay in the house forever, basically.
Yeah. And the thing is, I think people want to age in place. They may not want to age in place in the house they are right now, though, but they want to age in place in a personal residence, not in a nursing home, right? If they live in a house where they raise their family and there's lots of deferred maintenance, it's going to need a roof and all this stuff done to it soon. And the laundry room's down the basement and their bedrooms up on the second floor. At some point, those things are going to get difficult for them. So they may want to sell that house that's not aging in place appropriate, take the net proceeds from that, use a reverse mortgage to buy a new house where they could do 1-floor living and live in that house longer because it's set up to age in place. Yeah.
Interesting. That's an interesting perspective. That's very good.
And some people, they stay in a house that's not really appropriate for them just because they don't understand about the HECM for purchase option and all the, they think the only way that they can get a mortgage payment or mortgage obligation free lifestyle is to have to pay cash. And they know they can't get a house they're going to want with what cash they have, when they know they can increase their buying power because maybe they only need 50, 60% of the sales price of the house of their own money. And the rest is going to come from a loan that doesn't require monthly mortgage payments. It's another way other than paying cash that they can get, a lifestyle where they don't have to make a mortgage payment.
I think that's a big education point, Julie, because I think people would think when they think of a reverse mortgage, it's, to be able to stay in my current home. And you're right, so many homes are not appropriate for aging in place.
Right.
And Brett and I talk a lot about, being proactive.
Yes.
Yeah.
Just tough for people.
Oh, yeah. And I've worked with people, like their kids were the ones who got in touch and they are going to use the funds to make the house that they're in able to age in place, or maybe going to put ramps in, or maybe going to put a bathroom down on the first floor and make sure that they can live on 1 floor and things like that. So they can use the money to make the home that they're currently in, more accessible for aging in place. Another thing, people want to move closer to family, right? So especially when they get older and they have grandkids, they don't want to be that far away from them. Sometimes people want to go into a low maintenance community because they live in a place that has a couple acres and they're cutting the grass themselves and all that stuff. And they're realizing when they're 80, they're not going to want to do that. So it's a good time to move into a community where you have less outside work. Or age qualified communities. People like in a certain age of their life to be around other people in that same age group. It's like we were talking about earlier, all the activities there are to do. When I got into my neighborhood before I lived in a 55 plus community, we were like the young ones moving in. We were the ones having the parties and the neighbors were complaining. Well, my last few years there, I was the complainer.
Yes.
The neighborhood totally changed. I'm like, all of a sudden, we're the old folks in this neighborhood and we're complaining about the parties they're having next door. So there's something to be said for being in a community where everybody is going to be, you know, within a couple of decades there, and people with the same interests and, you know, people you can be friends with. So these age qualified communities are really nice for a lot of reasons.
So we talk about, obviously, on the ABCs of senior housing, you know, Lydia, we always talk about the pros and cons. We talk about, you know, proactive versus reactive. We always try to give people two sides. Could you tell us, Julie, about the pros and cons of your program, and what do you see out there?
Yeah, I mean, there's no one size fits all type of financing, and people have different unique situations. So we try to look at each, you know, different person's situation. And if I'm talking to somebody and I think it's not a good idea for them for some reason, I'm going to tell them that, because, you know, years down the road when it is, you know, maybe a good idea for them, they're going to call me back or they're going to tell their friend about me because I did the right thing by them. So I try to educate people in what it is and make sure it is in fact a suitable thing for them. You know, I've got a lot of years in this business still, and I keep in touch with my borrowers. I would be horrified if anybody ever called me and said they were unhappy that they did this. But if somebody was looking at a short-term fix, this might not be the best option for them because of the upfront costs. We talked about the FHA insurance, but we didn't really talk about the cost of it. The FHA insurance is going to be 2% of the home value upfront as a flat cost. So if somebody has a $300,000 house, right off the bat, there's going to be a $6,000 fee. And that's on top of your normal type fees that anybody would have, whether it's a traditional mortgage or a HECM when they're refinancing, right? You always got title insurance and notary fees and flood certs and credit reports and all that good stuff we see in every single loan that there is. But you do have the 2% FHA insurance that goes into the FHA insurance fund. There's one fund, whether it's a regular FHA mortgage with payments or whether it's a HECM that doesn't require payments. And that's so if somebody leaves their house at the end and it's underwater, they're going to make the lender whole. But there's two costs to that. There's the 2% flat up front. That's one of the closing costs. And then also FHA charges 0.5% of the loan balance per year. So the loan is rising by an interest rate because they're borrowing the funds. And again, it's just on what's drawn, and then 0.5% to keep continuing financing the loan. So if it's for a short-term use, those costs aren't necessarily going to be something you want to do if you're going to be somewhere for 1 year or 2 years. So that could be considered a con. I've had some people contact me. They maybe had an adult child living with them. Maybe it was a special needs type situation, or they're just very down on their luck. And they know when they pass on that the adult child needs to stay there and keep the house. In a case like that, it might not be the best idea for them to have any kind of a loan. That person to keep the house is going to have to pay off the loan. So non-borrowing spouse, they can stay and be protected, but that's just for the spouse. If there's another family member living with them and they want to make sure that they can keep the house if they become deceased, then that's probably not a good idea because they would have to have the loan.
Got it. That makes sense.
Yeah.
Julie, can I ask you in terms of the FHA insurance fees, have those fees changed over time or can they change?
They can. As I say, in the 15 years I've been in the business, I think they've changed 4 times.
Okay.
Usually in October, that's HUD's start of their fiscal year. That's when we see changes being made. There's a program that was around maybe 8 years ago that we're all lobbying to bring back, that it was called the Saver program. That was a beautiful thing, because if I had people that weren't going to use more than 60% of their proceeds in year 1, their upfront FHA costs would only be 0.5%.
Got it.
Then they were charging 2.5% to people who needed all the money. So it's like risk-based pricing. It made a lot of sense, but HUD did away with the Saver program. I would love to see something like that come back for people who just want to set up an emergency line of credit. And that's their reason for taking out the loan. They're not planning on taking lump sums out or taking, a substantial amount out year one. For right now, it is 2% for everybody. And it's been that way for quite a few years.
Okay.
Yeah. And there are traditional FHA loans you're familiar with, the loans with payments, where the underwriting is very similar. The upfront insurance and the ongoing insurance is different for their loans than it is for ours. Yeah, so ours is its own program. If any of the people I'm talking to, whether it's for a purchase or refinance, I always ask them if they have a trusted advisor they work with, if they have a financial planner, if they have an attorney, somebody who's trusted that they count on to help them make their financial decisions. I always tell them I'm happy to talk to that person for them, send them the analysis. That way, my prospective borrower can get the educated opinion of their trusted advisor. And it's good too, because then those folks know what this is about. They might have other clients down the road that can benefit from it as well.
Right.
That's a great point.
That's
And
very
smart, because we have a lot of these trusted advisors as guests as on the ABCs of senior housing, like our elder attorneys and all. And we think that that's excellent advice, Julie. We like that.
Yeah, absolutely. And sometimes they'll have kids they want to have involved too. I've
Right.
had times where there's been meetings with the adult kids and their feeling is they need to take care of the house when I'm gone, so that I want them to understand how this works and things like that. Like I said, it's a smart program. It's not needs-based. There is still some of that. People have an idea it's for needy people. On refinances, most people don't want anybody to know they did it because they're afraid of other people thinking it's a needy program, right? For the purchase, people think it's a really smart thing to do, and they'll tell everybody that they did it. They want everybody to know they found a way to buy this dream house of theirs, and they don't have to make mortgage payments, and they didn't have to pay cash. It's just a really smart thing. But I've actually done HECM for purchases for financial planners, for attorneys, for CPAs who use it for themselves or referred their parents to me when they wanted to get their parents moved back closer to them. So,
and what makes so much sense about this is you're also, what I never really thought about, you're able to get out of the house that's not appropriately laid out. So the laundry room's on the wrong floor, the steps aren't, it's multiple steps, your bedroom's on the third floor, and you can get into that one level living situation, which is perfect. And you can finance it, with a reverse loan.
right.
The one question, Julie, we ask of everyone as our guests on the ABCs of senior housing is, when should somebody contact you? Is there a certain time? I remember we asked that question to one of our elder lawyers, and I think her answer was when they were like 18 years, when their kids were 18 years of age, because you should start the process and the conversation early. Is there a time that you think is the right time for someone to call you?
I do sometimes get calls from people who are just 60, who just know enough to know that this exists and they want to know what it is because they're making plans for the future. And I think that's a wise thing to do. I have some people who'd love to use it to buy a house, but they're too young for it. But they'll call and talk to me and understand what this is. And they may make the buying decision because they know a few years down the road, they can buy with the traditional mortgage now. And that was always my plan when I bought my house, or I probably would have bought it at a different price point. But I bought my house when I was 55. And my goal was when I turn ready to retire, I want to be at 50% equity. And by all means, I'm going to convert my Wells Fargo mortgage into a HECM so I don't have payments. Because I think anybody, when you're in your retirement years, you're no longer accumulating assets. You're no longer growing, right? So the whole thing is about retaining what you've managed to save over all those years you've worked. And the best way to retain that money and use it slow enough that it lasts is to not have big bills monthly, like a mortgage payment. So it lets people keep their retirement funds intact so that they last longer. But people might make a buying choice based on they know down the road they can convert that to a reverse mortgage and get out from under the payments. So I would say anybody, even who's 62, who's of age, whether they think it's something they need at this point or not, it would be good information for them to have. I think knowledge is power. So many times people come to me with a problem and they go, I don't know what to do. And I'll be, well, how does this work? What does that mean? And they'll go, I don't know. And it's like, well, no, you can't make a decision because you haven't gathered all the information to make a decision, right? So again, as long as they're talking to somebody who is going to look at it educationally and not be calling them every 3 weeks saying, are you ready to apply? You're ready to apply. Because I hate to say it, there are people out there in this industry like that, just like there is in every kind of industry, right? I'm not like that. I tell people, I won't call you. I'm here for you. If you call, I'll call you right back. And I always want you to call with questions. You know, you can call me 10 times. And if you decide it's not for you, we'll part friends. It's all good. I just want you to fully understand what it is. But, you know, as long as they're comfortable that somebody's not going to hard sell them, I think it's good information to have. I can put an analysis together for somebody in 10 minutes. It's not particularly time consuming. They can go through it and understand what it is. If it's not the right time for them, you know, it might be a case where they want to look at a reverse mortgage to pay off their existing mortgage. But if I can't get them enough proceeds to do that, they're going to want to wait a few years till maybe the house goes up in value and their mortgage balance goes down. And then they can look at it again in a few years when there's less of a difference and we maybe can get enough to pay that off. So gather the information, know what it is, so that when things happen in life, we all get to this age, we know life happens, not always in expected ways.
Right.
So
Very
be
true.
prepared, know what's out there for you to take advantage of if the need arises. Yeah.
So this
Well, I
might
can
be a good
certainly attest to
segue.
the fact that Julie is great to work
Yeah.
with. She was wonderful with our loan. She was helpful. I've called her recently with a silly question and she's always answered us very quickly. And she's a wonderful person to work with.
Thank you.
So Jane, could you tell us a little bit, like, when you were thinking about the reverse, and maybe this is bringing Tracy in, like, tell us about
Absolutely.
that, when that thought process and how you thought to do this.
Well, Tracy worked for Traditions of America and Julie was doing a seminar. And so Tracy said to us, Mom and Dad, I want you to go and listen to this seminar. She said, if it makes sense for you, then great. And if it doesn't, you know, you've only wasted an hour. So we went and we listened to Julie talk and oh my goodness, it seemed to us like, again, where's the pull? Where's the what
Where's the
if
catch?
or the hammer? And we talked to Julie over and over again, and she assured us that once we moved in, there would be no mortgage and we never had to pay that back. Now, my husband's one concern is he would like us to own this house so that we can give it to Tracy. Tracy says she doesn't want it.
Is that true,
She's going to get
Tracy?
money.
That is true.
Yes, she's going to
Okay.
get money in other areas. So
Okay.
that she doesn't need the house. But when we pass, she will have the option of selling the house if it assesses for more than it's worth or what we owe, then she will still make money. And if it doesn't, she can again walk away from it and doesn't have to do a thing. And that's what I like. So that we're not going to create a burden for her. And we were actually looking in Delaware, thinking that it would be, you know, tax-free and that's where we would want to go. But we came here to Traditions of America. We saw the houses, which are gorgeous. The first floor living, my husband and I both have knee problems. So using the stairs, we were in a 2-story and a basement. So living in, you know, one floor, we actually have 2 floors, but we don't go up. That's for Tracy and the boys. So we have the first floor bedroom and, you know, we have 3 bedrooms, 3 baths. The house is gorgeous. The community, I would recommend a 55 plus community to anyone who feels they need that social. If you don't want the social and you want the privacy of living at home alone, then a 55 plus community is not for that.
But you know something, Jane, you know what I've experienced? I've had so many clients that say exactly like that basically they said to me, like, I'm a hermit and I don't want to, 55 plus community is not for me. I'm never going to participate in this thing. And we've moved these people into the 55 plus communities. They're like different people. All of a sudden they're playing mahjong. They're in card games. They're going
Yes.
on trips. They're doing the book club.
Yes.
They're doing all these things. Don't you see the same thing?
I think people underestimate the value of socialization, or they feel that they're going to be pressured to participate. But like Jane's saying, you know, there are so many things you can choose. You might just want to play pickleball or mahjong. You don't have to be
Yeah.
involved in everything, but it's available to you.
Right. I don't think there's
Yes.
any pressure for
Right.
you to
Right,
participate
right.
in anything.
Right. You can pick and choose. And if you still want to be a hermit, you can be.
Yes, absolutely. And we do have a lot of people in this community that don't participate in
Mhm.
things.
Mhm.
But when they get sick, when their spouses are
Mhm.
sick or in the
Mhm.
hospital, we have a thing that
They
people
do.
make dinners for them.
That's
And,
lovely.
you know,
Yeah.
everyone is so helpful.
Mhm.
It's just been wonderful. When Judy's husband passed, we were all so concerned for her. You know,
Mhm.
Judy and I live in the same community. Everyone is just so thoughtful and helpful. I just think it's a wonderful, wonderful thing that, you know, if you need help and people know it, then that help is supplied to you.
You're a great marketer for it. I
Yes,
should
you
move
are.
there.
We might want you to come on these calls again. We like having you. Julie, it
Well,
seems like to
I
me,
get
the
it from my
one thing
daughter.
I'm hearing, and you know, it speaks to like a little bit on Tracy's side, is that she really doesn't have to worry. If, let's say, worst cases in, 10, 20, 30 years, the value of that home is less. That non-recourse feature of that reverse is huge. But what people don't hear is, yeah, there's that insurance. And isn't that all, isn't the 2% is what's paying for that benefit? Is that correct?
Right. Yeah. It's a costly thing. And some people see that number and it turns them off. But it's like I said to you last night, if I tell people they can have a loan with no set maturity date, they could literally live in that house for 30 plus years till they're 100 and something and not make a payment, right? No obligation of making mortgage payments, no chance of debt at the end. They actually would make it easier on the kid if it did end up going underwater, because they would take 30 days to get mom and dad's possessions out and say, here's the deed. I don't want to bother selling it because there's no money for me to get. On the flip side, though, as long as the house can be sold for more than what's owed, that's going to go to the heirs, or it's going to go to the borrower if they're just moving into, a facility somewhere. Good friend of mine bought a house here at Traditions 5 years ago. She met somebody in the community. They got married last Saturday. So she sold her house here and moved a block and a half down into his house. We've had good appreciation in those 6 years. It far outpaced the growth of her loan balance. She's, her loan balance that she started with, she's leaving with really substantial money, probably pretty much everything she put into it 6 years ago when she did a HECM for purchase. So
Nice.
anytime, you get the advantage of that appreciation. Anytime you can sell the house for more than what you owe, that's your money to keep. And we've had people, I have somebody I've done 3 HECM loans for.
Really?
They used a HECM for purchase in Delaware, hated where they were, wanted to come back to PA. As long as that house is sold and paid off first, you can use it again, even if it's the next day, right? They built a new house in, I think, Lebanon together, her and her husband. Unfortunately, a year later, he died. She wanted to be closer to her daughter and grandkids and have a smaller house. She sold that house that was HECM for purchase, bought a third house that was suitable just for her. And she, just like people buy real estate when they're younger and then take the equity and sell a house and use it to buy the next one. That's what
me.
Yeah.
That's my program.
Yeah. Yeah. And
Julie, let me ask you, are you able to have a vacation home, like a second home when you have a HECM loan?
you can have it. Yeah, you can't finance it with the HECM, but actually a lot of the people I work with do have vacation homes. And if it's a refinance, like say somebody has a free and clear house in Pennsylvania, and let's say they can borrow 200,000 out of that in a reverse mortgage, they could take that 200,000 and buy a Florida condo with it, because you can use your proceeds for anything you want. And then they would own 2 houses, have a mortgage, but no mortgage payment. Yeah, we have to be able to income qualify them for the properties they have, and make that work with the residual income that they need to have. But yeah, absolutely. I work with people who have maybe some investment properties, or they're going to keep their departure home as a rental, or they have a vacation home. Yeah.
Okay, great.
This is awesome because there's so many misconceptions, I think, of what a reverse is and how it works. And, you hear different things, but it's the knowledge. The knowledge is key and it's power. So we're really appreciative. Are there any tricks or tips that you'd recommend for the people on the call? We have a whole bunch of people have signed on the call now. So is there any tips or tricks you'd recommend for everyone?
Just employ some out of the box thinking, because I think how we were all raised, the American dream was you buy a house, you take 30 years, you pay that house off, and that's your legacy to your kids. But if you actually talk to most kids, they don't want mom and dad's house. They might want the money from it, but they've got to go through the hassle of selling it, right? And you don't even know what it's going to be worth. You might have paid $350,000 into that house, and then when you become deceased, it's only worth $280,000, and it's a bad market, and the kids can't sell it, and it's really not a good thing to leave kids, to have them have to deal with a house to sell. So, kind of outside the box thinking, do you want a house for your kids, or you want some type of a monetary legacy? Usually it's a monetary legacy that they want. And there's people who've done studies on these loans, that if people get a reverse mortgage refinance and they start using the home equity combined with their other assets, the retirement accounts that they've saved up for their Social Security and all of that, and they coordinate what comes out of what when, they can actually end up with a higher net worth at the end than if they never touch that home equity. So if they don't have a financial planner, it might be a good thing to bring a financial planner and get involved with it, and take a look at this. What happens if I do this loan? What happens if I don't? How am I going to have the most legacy for my kids, if that's what my concern is, or my buy-in for a nursing home, if that's what my concern is? Because they choose how much of the loan proceeds to use. I might make $200,000 available to somebody, but they maybe will only use $30,000 of it before they decide they need to move elsewhere. So it's not in their payoff. They're going to get it all back when they sell the house. So they control how much of it they use.
And when they get that fund, is it kind of like, is it like in a check? Do they have like a checking account? How do they get advances?
A lot of people think this. It's not like we take that money and we put it in an account for them and they choose when to withdraw it, right? It's more like borrowing power, like a credit card or something like that. So if they have $200,000 and they don't need it right now, it's going to be in a line of credit. They're going to get on their statement every month, and they're going to see that it's been growing, and they can make a draw out of it. And only then is it going to be in their loan balance and accrue interest. But yeah, they're going to choose how much of that to use, right? And I'm going to show people amortization schedules, and I can see, okay, if you're going to take this much a year for the first 10 years, this is what it looks like at year 10 if that's when you leave the house. So I'm able to give people a good idea down the road what it looks like, but they are at the end the ones who decide if they're going to use the money, and if so, when.
Awesome. Wow. I think this was phenomenal information. We were so appreciative to have you as a guest, and we liked having Tracy and your mom. That was awesome too. It's such a great testimonial to what you do and how this program works, that we're ecstatic to have you guys. So thank you. I want to tell everyone on the call to please connect with us, like us, stay in touch with us on social. There's a whole bunch of things we do, and everyone on the call will be sending out a survey. We like to hear, we've done 9 of these ABCs of senior housing presentations. They're all available, by the way, on the website. So those that have missed some of the earlier ones, maybe you want to hear about how you can save $500,000 on the sale of a primary residence. That was one of our recent webinars. And we did a really deep dive, kind of like this. There are a lot of misconceptions in how to save a lot of money when you're selling your house. So we did a whole workshop webinar on that. So they're all available. There's 9 of them. Julie, yours will be also available. It takes us about a week till we process it and do what we need to do. And those that have registered that weren't able to come, we had gotten a lot of calls today. Things happen, obviously, and we'll be sending a copy of the webinar to everyone that signed up. But Julie, is this the best way to reach you? Is it your telephone? Are you an email person? What do you like best?
Telephone, email, it's all fine with me. Yeah, I don't think my email is actually on there, but
sorry.
Yeah, it's jdidyoung at longbridge-financial.com.
And we talked earlier, it sounded like your company you can handle pretty much every single state. Is that what I heard? But you're
right.
There were certain states that you were licensed for.
Right. Yeah, I'm licensed in 6 states up here in the Northeast, but we do have representatives that cover every state in the country. Yeah.
Awesome. And
even Hawaii, I was going to volunteer to go take that post in Hawaii.
I wonder why.
Julie.
I take one for the team.
We might join you. Are we able to come with you and in your suitcase? And
somebody's got to sell the houses on financing.
Okay. So we wanted to take this time, and it's interesting. I'm not sure what to say, but this is the first one. Lydia, I didn't receive any questions. So either you did a fantastic with explaining the process. I thought we were going to get more questions, and this one, for whatever reason, we didn't get any questions. Is there anyone? You have the chat function. We're going to stay on for a couple more minutes. If anyone has any questions, we're welcome to answer. Anything, Lydia, that we didn't answer that you wanted
Yeah,
to?
this has been such great information, and I think it's Julie's done such a great job kind of putting some myths to rest with reverse mortgages, and it's making me really think about a lot of things too. And yeah, and I just think this information is just so valuable. So thank you, Julie. This is just really great.
Tracy, anything that you think that you wanted to add?
I just think it gives our buyers and sellers so much flexibility now. They just have more information and more knowledge, and they're able to do what they want. I agree with people when you start to age. I mean, I live in a rancher, and I don't ever plan on going and buying anything with steps ever. I'm, in my 50s, and I'm thinking about it. I'm thinking about the 55 plus community. I'm thinking about my future, and I think it's important for everybody to do it.
Mm-hmm.
And
But you
Tracy,
only
the
look
other
like you're in your 20s.
Yeah, you do. And it sounds like also from the call, with everything that Jane said about a particular facility that you spoke very highly of, and Tracy, you're very familiar, having worked with that facility in the past, correct? That you could handle people that are interested in buying in that community. Is that you're going to be kind of busy probably from this call, I'll bet, Tracy.
Absolutely.
So hopefully you're okay with that. And of course, Jane, anything you wanted to add?
Just that if anyone needs a realtor, I know one that is wonderful to deal with.
I love it.
Tracy, I was almost going to say DeVito. Tracy Friedrich is a wonderful realtor.
Who's very, very experienced, by the way, and also in the senior world with your senior designation and all the facilities you work with, does an excellent job for people. So I will second that motion, Tracy.
Thank you.
And we did get a question. I'm so happy. Julie, how does a reverse mortgage work with a current mortgage? I'm going to assume the person's maybe in an existing home, has a current mortgage. Now they want to know, or can they add a reverse to that? Do they have to pay off the first so that the reverse replaces the first?
What kind of mortgage?
I'm assuming they have a current mortgage on their house. The question was a little vague, but I'm just trying to read into it a little bit.
Okay, current. I thought it was some special mortgage I hadn't heard of, but now I understand.
No.
Yeah, they don't have to have the house free and clear to apply for these. A lot of times people will apply with the goal of taking the reverse mortgage and paying off the mortgage with payments. So they'll still have the mortgage, but they don't have the obligation of payments. They just, in that case, I need to be able to get them enough in proceeds from the HECM that they can cover the payoff of what they owe. So they need to be probably at like 50-ish% equity, for me to get enough to pay it off. But sometimes, if I tell people, all right, your payoff is $200,000, I can get you 180 through the loan. Sometimes they will, and no financial planner will be all for it. Pull that 15,000 out, add it to the reverse mortgage, so you get rid of that payment for good. Because if they're planning to stay in that house in the long run, that's more beneficial to them to put their extra money in it to get that paid off than to keep up with those monthly payments for good.
Got it. Okay, that makes sense. Because that was a great question. But I wanted to also tell everybody, all these presentations are available on the website. You can go to our website, which is right where my little laser pointer is. Hopefully you can all see that. And I also want to tell you, those on the call, you'll be getting all kinds of promotional things we do. Like we just did for Thanksgiving, we give out pies to everybody. We have apple pies and pumpkin pies. And then for Valentine's Day, we do flowers, roses. For Mother's Day, we did flowering plants. We're working on another one, hopefully for fall. So we do tons of different things. So please connect with us and connect with us on social. I don't see any other questions. So I'm going to thank everybody for coming. This was wonderful. Julie, we are super grateful to have you. I'm sure you'll handle questions. Then there'll probably be some forthcoming questions from the people listening. Lydia, always, you're a pleasure. We love having you. Your background and what you bring is awesome. And Tracy, thank you for sharing your mom with us and some information today. She was awesome. We loved your commercial too, Jane. So thank you for that.
You're very welcome.
We'll probably invite you to other things too. So everyone, have a great day today. Thank you for coming, spending your Saturday with us. We're very grateful, and stay in touch.